60 Minutes coming out with house prices plunging by 40%. Now, what I wanted to do is just go through exactly what they were talking about and then also go through why I don't think things will crash by up to 40%. Now, I do believe that there is going to be a correction in city market, and we've already seen that. I actually have a video, if you go on my YouTube channel, November 16, 2016, I put out a video saying stop buying in Sydney market, it's overpriced, you don't want to be in at the peak of the market. Now, of course, all media outlets don't see things until they happen. So we've experienced it now with a downturn of around 5%, maybe a little bit more in some areas. But if you had have listened to what I said, you would have actually realized that you shouldn't have been buying from 2015, 2016 onwards, because generally those properties were so overpriced that we couldn't see people affording to be able to purchase that property and get a higher loan. So we knew that they were unaffordable, and what we do here is work out what the affordability is for each area and then why that area will grow in value. So at that time, we were then looking to Melbourne, which we doubled our money in Melbourne, and we also now look to Brisbane. So it's all about knowing what's happening in the market. See, they're talking about drops up to 40%, yet Perth isn't actually growing, it is declining now. And Darwin's in the same boat as that, as well as Melbourne has had some really significant growth, and we're now seeing some of the outer regions growing quite well. But if you were to look at, say, Brisbane was actually down and out from 2009 when it previously peaked till now, currently 2018. It hasn't really done that much. And what I was telling people was you always want to buy in a market that's down and out and then look to why it's down and out. And then when you buy in that market, you're going to get the full upside potential for growth over that next to 5, 10 or 15 years. And that's why we were buying in Brisbane market rather than Sydney market. So it's all about getting in before other people. Now, let's say the house price dropped 10, 15% in Sydney. We're still seeing record growth. So a 15% decline, even a 20% decline isn't drastic. It's only a very dramatic decline to those who got in late. And this is what always happens throughout every cycle is you go to a barbecue, everyone's talking about how much money they made, and then all of a sudden you jump into the market, you jump in late because you don't understand the market or the market fundamentals to what is going to make that market grow and how far will that grow until we've hit the peak of the market. Now, when I invest, I make sure I invest when everybody is scared of the market or is a market that's recovering. So when I buy in Sydney next time, it'll be when everyone else is fearful of Sydney and that I see the potential for Sydney to grow in the next 5 to 10 or 15 years. Now, I think Sydney obviously has good long-term potential, and no one can argue that with what's happening with jobs and population and all of that, but the affordability side is what's hurting Sydney market currently. So when you are looking at what's happening in a market, remember there's many markets within markets. So just because they say prices drop 40% or they're going to drop 40%, that does not mean that Australia-wide prices will be dropping. What we're actually seeing in some states is prices increasing because they've already gone through the drop in their cycle and they're now in a recovery market. So you've got to be looking at the fundamentals of each market and then the fundamentals of the market within that market. Because at the end of the day, it's not just about, Australia-wide, it's about having multiple markets within those markets. That's why I talk about diversifying property and diversifying them throughout states, different states, because you want to minimize your overall risk. Now, if I had 10 properties in Sydney, all of a sudden I'm going to have greater risk now if property was to drop 20 or 30%. But if I had 1 or 2 properties here, 1 or 2 in Melbourne, 1 or 2 in Sydney, in Queensland, now all of a sudden what I'm actually seeing is I'm seeing some decline in Sydney, which I've already made 80% on, or even more. So if that was to decline 15, 20%, it's not, that dramatic. You're still up, you're still making money. And then we've leveraged that money in Brisbane, where that market's actually continuing to rise over time. Again, it's all about cash flowing these properties and this portfolio for 15 years. If you can't cash flow for 15 years, you should not buy the property. So it's all about building these long-term portfolios, diversifying the portfolios, not listening to the noise. Now, like I always said, 80% of investing is in the mindset, it's psychology. 80% and 20% is actual investing. So if you can get those right and have a really strong mindset in investing, you will be able to achieve those goals. But when you start listening to media, which is roughly 18 months to 2 years late on the news, which is what we called 18 months ago, even more, they are now scaring everyone, which if they had the correct data 2 years ago, they should have been saying this. But they aren't saying it because they more like react to what's happening in the market rather than forecast what's happening to the market. So get your facts right, go out there, invest safely, always invest safely, and diversify your portfolio.